Snowflake reported quarterly financial results that sent the stock price soaring. In this video, I'm going to review those quarterly financial results and also answer a question that I've been getting a lot of lately from my viewers, which is, do I think Snowflake stock is a buy at these new higher valuations? I'll answer that question in this video. I'll share with you my fair value calculation for Snowflake, my proprietary discounted cash flow model, which calculates a price that I think is fair to pay for Snowflake, and I'll look at valuation on a forward price to free cash flow basis to determine if I like Snowflake at the current market prices. So let's jump in.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Two of the key numbers that investors need to look out for in every quarterly update from Snowflake is the company's net revenue retention rate and the remaining performance obligations. The net revenue retention rate came in at 125%, which was really good. The reason why the net revenue retention rate is important is because it measures how much existing customers are spending with Snowflake in their second year of service. So it tells me how good the customer value proposition is that Snowflake is offering its customers. And if you read my book, like thousands of you have, you'll know that the customer value proposition is one of the 6 steps I evaluate when I'm determining if I like a stock or not. It's one of the critically important factors. It tells me how sustainable the company's revenue is, how sustainable its revenue growth is. If existing customers are spending more money with Snowflake, that tells me they really like the value they're getting in return for the money they're spending. And that means that new customers will like or likely to appreciate the value they're getting as well. So that tells me the opportunity is larger for Snowflake. At 125%, the net revenue retention rate suggests that existing customers in their second year of service are spending 25% more with Snowflake than they did in the first year. So that's a really good sign. And also, I've evaluated Snowflake stock and it has one of the highest net promoter scores, the NPS score, among any of the companies I'm following. So the customer value proposition, Snowflake scores an A+. The next thing to evaluate is the remaining performance obligations, and it came in at 6.9 billion, and that was 33% higher than where it was in the same quarter last year. The remaining performance obligations is a measurement of new contract signings for Snowflake subtracted by current performance they delivered in the quarter. So Snowflake, when they sign a contract, for instance, let's say they sign a 5-year, $50 million deal, that $50 million goes into remaining performance obligations. It doesn't go into revenue. It only goes into revenue after they perform the service. So every month that they perform whatever they contracted to perform, then on a monthly basis, on a prorated basis, the RPO turns into revenue. So with RPO, what you're getting is a number that shows you what revenue is going to look like over the next few quarters and over the next few years. So if RPO is rising, that means that revenue growth is likely to increase as well, especially if you see RPO increasing faster than revenue is increasing. That's a great sign that the business is accelerating. And you did get a hint of that with Snowflake. The RPO increased by 33%, revenue increased by 32%. So you did get a slight beat in terms of RPO to revenue, not much, but it's better than nothing at all. The management team is optimistic, saying that they have an enormous opportunity ahead as we continue to empower every enterprise to achieve its full potential through data and artificial intelligence. Of course, data is at the core of artificial intelligence, and the more data you have, the more proprietary data you have, the better capable you are of building AI systems that enhance your decision making at the corporate level. So now let's take a closer look at the income statement. For the 3 months that ended July 31st, 2025, Snowflake's revenue increased to 1.144 billion, up from 868 million in the same quarter last year. The operating loss improved. The operating loss came in at 340.2 million. That was an improvement from 355 million negative. Both of them were negative in the same quarter last year. So the company is still losing money on the bottom line. But I've often said I don't mind companies losing money on the bottom line as long as they're demonstrating improvement and they're demonstrating a path to profitability and hitting milestones that gives investor confidence that they can become profitable if they continue at this level. Snowflake has definitely demonstrated improvements in reducing losses, improving the operating loss to revenue ratio. Now, in addition to lower operating loss, right? The operating loss improved from 355 million to 340 million loss. But also, if you divide the operating loss by revenue, the percentage improved meaningfully as well. Because in the same quarter last year, they lost 355 million on 868 million in revenue. In this quarter, they lost 340 million on 1.144 billion in revenue. So the operating loss to revenue ratio also improved. That's also a good indicator. Sometimes you'll have companies that they grow revenue and they just lose money on the bottom line. Their unit economics are extremely unfavorable. And again, I'll point to my book. That's another step that's important in evaluating a business. There's a whole chapter evaluating unit economics. And with Snowflake, it's a bit more difficult to evaluate unit economics for a software service because each incremental customer is so profitable because most of your investment goes at the corporate level, building out the technology that supports the business. And then each incremental customer gives you significant contribution profit, which narrows your losses and improves your profitability. And that's what you like to see in software companies. And that's what we're seeing with Snowflake. As revenue is increasing, the losses are improving and they're making progress towards profitability. But the company is well on its way in generating cash flow from operations. And in the 3 months that ended July 31st, they made a nice improvement, generating 75 million in cash flow from operations compared to 69.8 million in the same quarter last year. Now, that was a big relief because in the first quarter, the company didn't improve year over year. And if you look at the 6 months, which ended July 31st, they did not make improvements. Their net cash flow from operations were 303 million compared to 425 million during the 6 month period in 2024. But most of that is attributable to timing in accounts receivable worsening from the same time last year to this year. So now that we looked at the important financial performance metrics, let me share with you my proprietary discounted valuation model. So I will share with you that I did update this price today after I evaluated the company's earnings results and I incorporated the latest figures into this valuation. And I will share with you my intrinsic value per share increased meaningfully. Prior to this quarterly update, my intrinsic value per share for Snowflake was around $130 a share. Now it's at $153 per share. So there was a roughly 20% improvement in the intrinsic value per share calculation after I evaluated the company's most recent financial results. Still, it's well below the current market price of $239, suggesting that the stock is still overvalued. And this has been a business that's been consistently overvalued. It's a premium business. As I mentioned, A plus in the customer value proposition, A plus in the unit economics, net promoter score, best in class, improving margins, a lot of things working well. So it's almost always traded at a premium valuation. This isn't one of those businesses that's you've been able to buy that's frustrated investors who have looked at it and said, why is it trading at such a cheap valuation? Why doesn't it improve, right? The companies like PayPal and Alphabet are those kinds of businesses where you're like, why does it keep trading at such a cheap valuation under the fair value and such a low forward price to earnings ratios, right? That hasn't been the case with Snowflake, consistently trading at premium to super premium valuation. When I go to fiscal.ai, which is my preferred data provider, there's a link in the description if you're interested. And I go to the forward price to free cash flow, it's trading at a forward price to free cash flow of 60, which is about the midpoint of where it's traded at going all the way back to January of 2024. So according to this valuation metric, it looks fairly valued. I think a forward price to free cash flow of 60 for a business performing the way Snowflake is performing, given its characteristics, I think that's a fair value. So overall, I would only say that Snowflake stock is just, slightly overvalued. I would say by about 10% or so. Right. So to update my buy, hold, or sell recommendation for Snowflake stock, I'm keeping this stock rated as a hold. The current market price at $238 per share is a little bit more than I would like to pay for this business. If you can get this stock at 215 or below, I think it would be an attractive entry point for long-term investors looking for high growth potential with a longer term growth stock.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.